Okay, good morning, everyone. Hope you're having a good day today. Today, we're going to start Chapter 9, which, as you can see in the PowerPoint, deals with internal control assessment and the testing of internal control. I'll expand upon this more as we go through today's lecture. Just a couple of points, though, with respect to the midterm exam, which is coming up in a couple weeks' time. It's scheduled for February 24th. It will be held during normal class time. The format of the exam, in terms of what you can anticipate, there'll be approximately 10 short answer questions. They'll be worth 2 or 3 marks each. So typically I'll ask you to list certain things, okay, or to comment in short answers on certain questions. In addition to the 10 questions, which I call narrative or short answer questions, there'll be approximately 20 to 25 multiple choice questions. All of the questions, the short narrative questions and the multiple choice questions, are of course based on the PowerPoints that we've covered in class up until this point, together with the comments that I've made throughout the lectures. So in terms of what you need to study to prepare for the midterm exam is exactly that. Go back through the PowerPoints, make sure you're comfortable with them, review your notes. If you have any questions, certainly send me an email. I'll be happy to deal with any questions that you have to ensure that you're prepared for the midterm exam. The midterm exam will be written during normal class time. So it will be, the process essentially will be, I'll be uploading the midterm exam at approximately 10 minutes before 10, so just before normal class time starts. You'll be able to download it at that point and start the exam. And then you'll need to return your exam to me by approximately 11:30. Again, I'll put this all in an email so you have it in writing to read. And if there's anything that you don't understand or have questions, please get in touch with me. So right now I'm anticipating the midterm exam will be 1.5 hours long. So I may lengthen it a little bit. It won't be any shorter than 1.5 hours, but it might be a bit longer. But again, once I create the exam, I'll document everything in writing for you so that you know the process. And again, if you have any questions, please get in touch with me. So moving ahead with respect to today's lecture, I guess in terms of the content as well, in terms of the chapters, everything that we've covered from chapter 1 up to today's lecture, not counting chapter 7, of course, because we did not deal with chapter 7, okay? So essentially it covers all the course material up until this point in time. So moving forward, as we normally do, I'm just going to bypass a detailed list of learning objectives that they have here. You can see it's very lengthy. In terms of the list, there's quite a few PowerPoints in today's lecture. If I finish them in today's lecture time, that'll be fine. If I don't quite get through all of them, we'll finish them up after the midterm, after the reading week. But of course, you're only responsible for material covered up until today's lecture, okay? So if we don't quite get through chapter 9, you will not be responsible for material, of course, that I do not cover in today's class. Okay, so the first PowerPoint we're looking at, it talks about the evaluation of internal control. So we've mentioned up until this point, essentially the auditors have 3 types of audit procedures that they perform. The first one is testing of internal control. The other 2 are what we call substantive procedures. The substantive procedures that we've talked about are analytical procedures. So analytical procedures are essentially just ratio analysis, basically, comparison of balances one year to another year, okay? And in addition to that, what we call tests of detail. Again, tests of detail essentially consists of going back and looking at original documents, okay? So invoices from suppliers, payroll checks to our workers, and things such as that, okay? So today we're zeroing in on the first part about testing of internal control. remember that auditors normally do want to spend a lot of time in testing internal control in order to reduce the cost of the audit. Right? It's one of the most efficient ways to conduct an audit. And so if management has a strong internal control system, it allows the auditors to reduce their work, which keeps the cost of the audit down. So that's good for the company being audited, of course. And it's also good for the auditors from the perspective that they can gather their audit evidence that they need to support their audit opinion in a very efficient manner. So with respect to evaluation of internal control for an audit client, as we can see here, it's speaking about 3 phases. So the first phase, it says identify the significant risks that need to be controlled and describe management's control procedures by documenting the internal control system in the audit firm's audit file. So if we're going to test internal controls that management has in place, we first have to understand what those controls are. But do we need to identify all of management's internal controls? The answer to that question is no. Management has many internal control procedures, but many of those internal control procedures are not relevant to conducting the audit of the financial statements. So the only controls that the auditor is interested in, and this is really covered in the wording here for phase 1, the auditors want to look at the internal controls that address the significant risks, okay? And the significant risks from an audit perspective, right? So those risks, of course, are related to management's assertions. So the auditors want to identify the risks, okay, with respect to management's assertions being incorrect, and then determining, given those risks, how does management control those risks? So how does management ensure that their inventory is not overstated in their financial statements, right? So the risk is overstatement of inventory. So what's the internal control that management has in place to prevent inventory overstatement? So all of these controls that impact the audit, those are the controls that we're most interested in, okay? So the auditors have to study and document management's internal control system before, of course, we can rely on it. So that's the first phase, is really identifying the internal controls that are relevant to the auditor for purposes of auditing the financial statements. Phase 2, it says assess the control risk at the assertion level, right? So that's what I mentioned a minute ago, is that we identify the internal controls that relate to the control risk at the assertion level being overstatement of assets, for example, existence of assets, right? Valuation of assets, completeness of liabilities, okay? So those assertion levels, those concerns, existence, completeness, valuation, what's the control risk as it relates to each of those assertions? And then we want to identify the controls that management has, again, to ensure that those assertions, right, are not incorrect or invalid. So we have 2 types of controls. The first set is what we call general controls. And we're going to see in a few more PowerPoints what general controls are. But essentially, they are the broad controls that exist in an organization. So for example, quality of staff, right? So if we have the best staff working for our business, that's going to impact, right, the control over the assertions, because good people can ensure that things are done properly. Right? People with less knowledge, there could be more errors that occur. So the quality of your people would be general control. Then in addition to general controls, we have application controls. So application controls are lower level controls, very specific to accounting systems or technology systems. Okay, so they're the detailed internal control procedures that take place. Okay, And so I often think about and use these terms. General controls are sort of the high-level controls in an organization. Application controls are the detailed day-to-day operational internal controls that organizations have in place. All of the controls are there to control the risks, right, that the assertions over the financial statements are incorrect. So the better our internal controls are, the better our general controls, the better our application controls, the less risk we'll have that the assertions made by management are incorrect. Okay? So essentially, phase one is identifying the internal controls that exist that relate to the assertions in the financial statements. Then we want to assess, once we know what the controls are, what's the risk for each of the assertions that the controls will work or not work. And then thirdly, we want to do internal control tests. So once we identify the internal controls that are relevant to our audit and identify the ones which we think are the best internal controls, we're going to determine, okay, how do we test that internal control to determine whether it's actually working or not? And then we actually perform those internal control tests. So we will be talking about what internal controls actually are and how we test them. Okay, we'll be doing that basically after the midterm exam when we get into each of the accounting systems. Okay, we'll talk about the internal controls in the accounting systems. And of course, once we identify the internal controls, we can identify how to test those internal controls. Once we test internal controls, phase three, it says at the end, once we test the internal controls, we can determine whether audit programs require revision. So by audit programs, what they're talking about is the balance of testing internal control versus doing substantive procedures. So perhaps at the start of the audit, we thought internal control was strong and we would be able to limit our substantive procedures. However, as we go along and test the internal control, maybe we discover, in fact, they're weak. And once we learn that the internal controls are weak or not working, that means we have to revise, right, our audit program and do more substantive procedures, not less. Okay, so this is part of what we've mentioned before. Auditing is an ongoing process that, as we gather more information, it may affect how we perform the audit. Okay, so we have an initial plan, but the plan may change as we gather more information. Okay, the next PowerPoint talks about the fact generally accepted auditing standards emphasizes internal control and the controls relevant to the audit. Right, so I've mentioned this already today, that management may have many internal controls, hundreds, right, hundreds of internal controls, but the auditor is only interested in the controls which are relevant to the audit. Which internal controls are relevant to the audit? The controls that are relevant are the ones that will reduce, right, the risk of material misstatement. Which controls will reduce the risk of a material misstatement? The controls which ensure that management's assertions, right, are valid and correct. Okay, so we'll test those controls to make sure that they're operating, and if they are operating, that reduces the risk of material misstatement. If the internal controls are operating, then we can rely on those controls. But again, we have to identify the controls first, document that in the auditor's file, and then determine how are we going to test the control, and then actually go forward and complete what we call the internal control, or we use the word compliance test. If the internal controls are working, okay, we say that the internal controls are in compliance. It just means they're working as they should be working. Now we come back to an item that we've discussed before. We're discussing now the importance of internal control from a management perspective. And as many of you work in business organizations, you'll see how important internal control is. But who is responsible for internal control? Again, it's management, right? It's not the auditor. The auditor is only responsible for rendering an opinion on the financial statements. One of the ways that auditors render opinions is by testing internal control, right, to substantiate their audit opinion. But the actual controls that are in place in any business organization are the responsibility of management, okay? And so management has to decide what controls they will put in place, and they should monitor those controls to make sure the controls are working. Now, when management makes its decision about which internal controls they're going to put in place, they're going to say, what is the benefit, right, of having that internal control in place versus what is the cost, right? So management may say, yes, we do not want our inventory to be overstated, so here's an internal control that could address that issue, but is the cost of having that internal control in place greater than the benefit achieved? Right? And when we say benefit achieved, we're talking about the reduction of risk. Right? If an internal control does not significantly reduce risk, maybe we should find a different internal control. Right? So management is doing a cost-benefit analysis as they decide which internal controls to put in place, because some internal controls could be better than others. So we're having a discussion in more depth today about internal controls. So it might be helpful to understand, what do we mean by internal control in a business anyhow? So this PowerPoint, number 9, gives us a definition. And this definition of internal control generally will be found in any standard auditing textbook. So of course it's in this textbook as well. So here's a common definition of internal control, and I'll just go through the words and explain to you what they're talking about. So internal control is a process, right? It's designed and effected by those charged with governance, so that's the board of directors, by management and other personnel. So everybody in the business, right, is deciding, right, what is the process. So it's a management responsibility, but again, keep in mind, management is overseen by the board of directors. And then, of course, we need people to actually carry out the controls in the organization. So hence, there's the reference to other personnel, okay? So it's designed and effected by everybody in the business, basically. Why do they do that? To provide reasonable assurance about the achievement of the entity's objectives. So one of the reasons that management has an internal control system in place is to help it achieve its business objectives, right? And what are its business objectives? They want to operate effectively, and they want to operate efficiently, okay? And so, of course, they'll have certain goals. So the better we control our systems, right, the better chance we have of achieving our goals. And so our goals with respect to what? The reliability of financial reporting. Right? It's important that our financial statements are correct so that our external users, right, have confidence that we're showing the real state of our business. Internally, we need good information. If we have good information, we can make better decisions, right? We have a phrase that we use, garbage in, garbage out, right? If our information is poor, management doesn't have a chance, right, at making a good decision because they're going to have bad information to try and make a good decision. What management needs is correct, accurate information to make good decisions. So we want a strong system of internal control in place to give us reasonable assurance that our financial reporting is reliable. Secondly, which I mentioned a minute ago, the effectiveness and efficiency of our business operations, right? And then we want to ensure that that same system will ensure that we're going to comply with laws and regulations in the countries where we're operating. Because, of course, if we don't follow the laws and regulation, then our business might be exposed to lawsuits, additional costs that we would incur to defend ourselves. So that's not a good idea, right? So this sort of good internal control system will protect us on the downside from additional costs of lawsuits, basically, okay? Or fines, interest penalties, all those types of negative things. So again, let's summarize. A good internal control system, right, is put in place by management, okay, who's overseen by the board, but also consists of the other people in the organization who actually carry out the controls. So that is the system. That system should provide reasonable assurance about achieving the business entity's objectives as it relates to accurate financial reporting, both for internal and external purposes, the effectiveness and efficiency of business operations, right? So we achieve our goals of profitability, we achieve our goals of achieving profitability efficiently, and that our business organization complies with laws and regulations to minimize downside costs, penalties, interest, and negative effects on our reputation, for example. What's the auditor's responsibility with respect to internal control? So the auditors, we've already mentioned, we have to evaluate the internal control system put in place by management, which reduces the risk of material misstatement as it relates to management's assertions. We want to find out what an organization does to avoid potential errors or other types of irregularities. Okay, so when we think about assertions and how could management's assertions be incorrect, they will be incorrect if there's errors, right, that creep into the financial system. So what type of errors or misstatements might occur in a set of financial statements? So we see a list of 6 general categories. So when management teams design internal control systems, they do so to overcome or reduce, right, the possibility of these 6 misstatements from occurring. So let's just walk through these to ensure we understand what the 6 common mistakes would be. The first one, invalid transactions are recorded, right? So management's internal control system should ensure that only valid transactions are recorded. Right? And of course, if only valid transactions are recorded, invalid transactions would not be recorded. Secondly, there's a risk that valid transactions would be omitted from the general ledger accounts. So a good system of internal control will ensure that all valid transactions, right, are recorded, right, that they're not omitted from the general ledger accounts. So with respect to invalid transactions, the system should prevent them from being recorded. With respect to valid transactions, the system should ensure they are recorded. The third type of error, unauthorized transactions are executed and recorded. So again, our internal control system should ensure that only authorized transactions would be conducted or executed by the business, and that all of them, of course, are recorded, okay, because they have been authorized. The fourth item, transactions recorded, they could be inaccurate, right? So we record them in the wrong amount. So a good internal control system will ensure that transaction amounts recorded are accurate. The fifth one, transactions could be classified in the wrong accounts. So for example, we might conduct a sale transaction, but record that as dividend income. Right? It should be recorded as sales, but we classify it improperly into the wrong account. We might call it dividend income. So a good internal control system should ensure that transactions are classified in the correct account, not in the incorrect account. And then the last general category of misstatements, transactions are recorded in the wrong period. So we're in February right now, February 2021. If we have a sale this month in February, which month should it be recorded in? It should be recorded in February. Right? We want February sales recorded in February. We don't want February sales recorded in January. We don't want February sales recorded in March. Transactions need to be recorded in the correct period. So a good internal control system will ensure that transactions are recorded in the correct period rather than in the incorrect period. Okay, so all of these misstatements, right, we could think about these and say, yeah, you can understand how these misstatements could occur, but a good internal control system will prevent these errors from occurring, or if they did occur, it would detect them and correct them. Okay, so we often talk about an internal control system should prevent errors from occurring in the first place, these 6 common ones. If they did occur, a good internal control system should detect the errors that occurred. And once they were detected, they should, of course, be corrected. Okay, so prevention, detection, and correction are key elements of an internal control system. Now, we've mentioned that auditors have to evaluate internal controls. So why do they do that? The primary reason for conducting an evaluation of internal control is to give the auditors a basis to determine the nature and the timing and the extent, it says, of the balance sheet, balance audit program. So when they say balance audit program, what they mean is the substantive procedures. Okay, so let's look at this again. The primary reason to do an evaluation of internal control is to give the auditors a basis to determine the nature, the timing, and the extent of their substantive procedures. Okay. Again, when auditors have to determine, right, they have to gather sufficient appropriate audit evidence. How do they do that? Through their evaluation and testing of the internal control system, and by doing substantive procedures. Right? It's a mix of the two. With respect to substantive procedures, we have both analytical procedures and tests of detail. Okay, so if internal control is strong, we can do fewer substantive procedures. If internal control is weak, we have to do more substantive procedures. But the only way we can determine if internal control is strong or weak is to identify the internal controls which are relevant for the auditor and then test them, right, to see if they're actually working or not. So as we gather that audit evidence about the internal control system, it affects our decision about substantive procedures. Specifically, it affects the nature and the timing and the extent of the substantive procedures. Now, again, in the text, and you'll see in the PowerPoint, they talk about excuse me, the balance audit program. They're really talking about the balance sheet audit program. So balance sheet, they're referring to assets, liabilities, okay, is what they're talking about. Okay, so we can go forward from there. And so the next couple of PowerPoints summarize what happens after the auditor does their evaluation and determine, in this case, what happens if internal controls are weak. How does that affect the auditor's procedures? So the first bullet point, it says, can sufficient audit evidence be obtained still by performing more extensive substantive procedures that would be done if controls were found to be strong? So if internal controls are weak, can we counter that by doing more substantive procedures? And if we do more substantive procedures, will that give us sufficient appropriate audit evidence to render our opinion? Okay. The second bullet point, the auditor must always report significant control weaknesses to management, so management can take action to address the weaknesses. Okay. Or if there were very severe internal control weaknesses, report them to the board of directors. So as auditors discover internal control weaknesses, they report the minor ones to management, the major ones to the board of directors and management. The idea is, as auditors discover weaknesses in internal control, they can help management to strengthen the system. If management strengthens the system of internal control, that's better for the auditors because perhaps in the future they can rely on those controls if they improve, right? And of course, with a better internal control system, that helps management to meet its objectives, right, in terms of reliable financial reporting, effectiveness and efficiency of business operations, and helps it to ensure that it's meeting the laws and regulations of the countries in which they operate. If internal control is very weak, okay, the last bullet point here, if weaknesses are significant, they mean weaknesses in internal control. Okay, so if weaknesses in internal control are significant, the auditor must ask themselves, are there serious doubts about whether we can gather sufficient appropriate audit evidence? So what they're saying is, if internal control is so weak, can we counter that by doing much more in the area of substantive procedures? We might not be able to even if we do more substantive procedures, that might not be sufficient in gathering sufficient audit evidence for our audit opinion. Now, most of the time it is, okay? So even with weak internal controls, auditors have to do a lot more substantive procedures, and normally, of course, they can do that and still render an audit opinion. But at least conceptually, it could be a problem that internal control is so weak that even more substantive procedures will not provide sufficient appropriate audit evidence for the auditor to render their audit opinion. So what the authors are really talking about here is, if internal control was so weak, that might result in an inability to gather certain audit evidence, right? Well, if certain audit evidence was not available, that might result in what we talked about previously, a scope limitation for auditors, because auditors need certain information to render their audit opinion. But if, as a result of an internal control weakness, certain information is not available, potentially it's possible that that could have a negative ramification on the audit report. Okay. Again, the next PowerPoint, they're talking about the interaction between the evaluation by the auditors of the internal control system and how that affects the substantive procedures. So on the PowerPoint, it says the internal control assessment will affect the procedures in the audit program, referring to, again, the substantive procedures. Each procedure should have identifiable characteristics of nature, timing, and extent. So what we're going to do after the midterm exam, the second project requires you to actually develop an audit program. And that in that audit program, you're going to see that we have to decide what's the nature of the audit techniques that we're going to use, okay? Are we going to do internal control testing? Are we going to do some substantive testing? Are we going to do both? What's the timing of when we're going to do the work? So are we going to do some of the work before the end of the year? Are we going to wait till the end of the year to do the work? Okay, so decisions around timing. And then the extent, how much work do we have to do? So for example, if we want to draw a sample, right, and look at repairs and maintenance expense for the year, and if there were 5,000 repairs to machines during the year in our company, how many of those 5,000 events do we want to look at? 3, 12, 25, right? We have to select a sample out of the population to determine how many are we going to look at, how much is enough. Okay? So nature of the test, they're talking about internal control tests versus substantive tests. Timing, before the end of the year, after the end of the year, and then extent is how much, okay, do we have to do. So here we compare what's the effect if we find an entity that has a poor internal control system versus an entity which has a strong internal control system. So the nature of the test, it says we'll have to provide more reliable evidence. This may be more costly. So if internal controls are weak, we have to do more substantive tests. Substantive tests involve more man hours, more hours of work, so they're going to be more costly. And even with respect to substantive procedures, it costs more to do tests of detail than it does analytical procedures. but the auditors have to make a decision here around which type of procedures are they going to do. Also, with respect to timing, the weaker the internal control system is, the auditors must do more of the work at the end of the year versus at an interim date, which means before the end of the year. Okay, so if management has a strong internal control system, the auditors can do more work before the end of the year. But as the internal control system weakens, the auditors will not feel comfortable in doing a lot of work before the end of year numbers are available. So they're going to have to wait, right? Which will make it more difficult, of course, to complete the audit on time. The more work we have to do at the year end, we might get into a time crunch. The last point says more evidence will have to be gathered, which is more costly. The costs of accumulating analytical information and test of detail information is more costly than testing internal control because it just takes more time. And so again, doing that is going to increase the cost of the audit. Okay, so we want to go on and talk specifically about each of the three phases that we identified a few minutes ago, okay? But again, I'm just looking at my timing here, so I think what I'll do is I'll just break for 5 minutes, okay? And then I'll come back and we'll start into a more detailed discussion about the three phases that we identified a few minutes ago as we started this chapter, okay? So I'll be back in 5 minutes. Okay, everyone, we'll continue on. We're going to get now into a more detailed discussion about the three phases that auditors go through with respect to the internal control system, understanding it, documenting it, testing it. The first phase, as we saw before, we have to understand the internal control system. It's done very early in the audit. So if we have a December 31st year end, very commonly, this would be done in the very early fall. So normally in a September, October type time frame. And we know we want to obtain, become familiar with the internal control environment. Okay. The internal control environment, we're talking about things like what's the tone at the top, right, in the organization, the flow of transactions, right? We want to understand how do transactions flow through the accounting system, because we have to understand that in order to understand what would be the potential errors that could occur in the accounting data. And then what's the effectiveness of management's internal control procedures with respect to preventing, detecting, and correcting errors in the accounting system. Now, a word is used here in the PowerPoint. You see it says key control. Okay, so we mentioned earlier today that management, in fact, has many internal controls. The auditors, however, only select a small number of those internal controls to rely on during the conduct of their audit. So even in the audit of a very large company, the number of key controls that the auditor would rely upon would typically be in the range of 25 or so. Okay, 25, maybe 30 internal controls. Management has hundreds of internal controls, right, built into their accounting system and their business operations. But many of those internal controls are not relevant to the financial statement audit. So the auditors, when they document management's internal control system, they select what they would consider the best controls, okay? And those best controls, they refer to those as the key controls in the organization. Those are the ones that the auditors are going to test. Now, what we're going to talk about next is actually one of the most important topics in the entire course, okay? So we have management's internal control system, okay, is designed to prevent, detect, and correct errors. What are the errors that the internal control system should prevent, detect, and correct? Those are the 6 errors we already spoke about just before the break. So I'm just going to go back in the PowerPoints for a few minutes. Okay, here are the errors. Right? We said these are the categories of misstatements or errors that could occur. So a management's internal control system should prevent, detect, and correct these errors should they occur. So if we look at, coming back to where we're at, when it says in control objectives, it's referring to what are the objectives of management's internal control system. The internal control system should prevent errors. The errors are the 6 errors we just looked at. So we have basically an intersection. I'll come back to this PowerPoint in a minute, the ones I'm just scrolling through now. But we see here PowerPoint 22, okay, is one of the most important PowerPoints in the entire course. On the left-hand column, you'll see it says objectives. These are the objectives of an internal control system, okay? And you see validity, completeness, authorization, accuracy, classification, proper period. Okay, so these are the objectives of an internal control system. Why do we have these objectives? It's to prevent, detect, and correct errors. So let's go back a few PowerPoints. We'll just look at the detailed wording. Validity. What does the word validity mean? Validity in an internal control system means that recorded transactions are the ones that should be recorded, right? So validity ensures that transactions which are recorded are the ones that should be recorded. that means that the transaction actually occurred or existed. So an example of an internal control procedure to ensure validity of sales would be to match shipping documents for goods shipped with sales invoices before a sale is recorded. So that internal control is saying we won't even record a sales invoice unless that invoice has been matched with shipping documents that prove those goods were shipped. Because we know if the goods were shipped, we can recognize the revenue. Okay, so the matching of shipping documents with sales invoices ensures the validity of recorded transactions because we won't even record the transaction unless this test has been fulfilled. Completeness. The internal control objective of completeness is to ensure that all valid transactions are recorded in the accounting records, right? So that means every shipment should be matched with a sales invoice. So if we have shipping documents, what this means is we track down all shipping documents to an invoice, right? Then we know that all goods shipped have been invoiced. So we know all the invoices that should have been recorded in sales have in fact been recorded, right? So we're testing in two directions here. And this is an important part of auditing. We call it directional testing. If you want to ensure that all sales invoices, right, are valid transactions, what internal control should you have in place? You should have the control in place that ensures a sales invoice is not recorded unless it's been matched with a shipping document, right? So you're tracing from the sales invoice back to the shipping document. With respect to completeness, you're testing in the opposite direction. With respect to completeness, you want to ensure all valid transactions are recorded. So when items are shipped, we have shipping documents. We want to ensure that that sale has been recorded. How do we ensure the completeness of sales invoices? We trace every shipping document to a sales invoice. Okay, so the directional testing, very important in terms of which internal control objective are you satisfying. So these are the first two. Authorization, right? Remember a few minutes ago, we were talking about errors that could occur with respect to transactions not being authorized. So in this case, it says authorization is ensuring that transactions are approved before they are recorded. So we would need an internal control that says we won't even record a transaction unless it's been approved. So the control system should stop unauthorized transactions from entering the accounting records. So for example, a journal entry will not be recorded in the accounting records unless it's been authorized by someone's signature or approval. That would be an internal control over authorization of data being entered into the accounting system. Accuracy, right? We saw one of the errors that could occur is that the amount recorded is not accurate. So an internal control objective is to ensure the accuracy of amounts which are recorded. How can we do that? Well, you could do a manual check of amounts before they are recorded, or you could have a computer, right, check the calculation before an amount is recorded. So, or you could use both, of course, in an accounting system. So various types of checks on the accuracy of data before it's recorded in the accounting system to ensure accuracy. Sorry, just noticed here that authorization has been double counted in the PowerPoints. Classification, right? We saw that one of the errors that could occur is that amounts, even though they are recorded, might be classified improperly, right? I mentioned earlier, maybe a sale might be recorded as dividend income. So we need an internal control in place to ensure transactions are recorded in the correct accounting accounts, okay? And so we would need an internal control to achieve proper classification. And then we saw another error that might occur would be recording of transactions in the incorrect period. So we need an internal control which will ensure that what we call proper period cutoff. Cutoff simply means are transactions recorded in the proper period or not. So typically, with respect to a company's bank account, a bank reconciliation, okay? A bank reconciliation is an accounting procedure that ensures that the balance per the general ledger of the company has been reconciled or agreed to the actual amount of cash in the company's bank account at the bank. Right? So companies, you can go online and see what the bank balance is, right? Just like you would go online and see what your own personal bank account balance is. Companies can do that as well. And then you reconcile that balance per the bank, right? Per the bank's accounting records to your own internal records. And you'll discover usually there are differences. You may have recorded some deposits before the bank did. The bank might have reported, for example, a payroll deposit before you did. You might have written some checks that haven't cleared the bank account yet, right? They're still outstanding. So we can have, right, various adjustments in this reconciliation to correct the accounting records. So the bank reconciliation process helps to ensure that transactions are recorded in the proper period. Okay? Because that's a very common procedure, of course, in virtually all business organizations. So we can see that the internal control objectives, right, listed in the left-hand column in PowerPoint 22, they are there to detect, prevent, and correct the errors, right, that we've talked about previously. But if the internal control system does achieve these objectives, the achievement of these objectives gives the auditor support over certain assertions, right, made by management in the financial statements. So if an internal control system provides for validity of transactions, meaning that only valid transactions are recorded, that gives the auditor, right, audit evidence about the existence of transactions in the financial statements. The auditor knows that they will only be recorded if they are valid, right? So by testing the internal control over validity, management can rely on, sorry, the auditor can rely on that internal control and do fewer substantive procedures over existence. Let's look at completeness. For completeness, we mentioned a few minutes ago, if we want to ensure completeness of sales, all shipping documents should be traced as sales invoices. So for the auditors do that, they do that test over completeness, right, of shipping documents being traced to sales. That gives the auditors evidence about the completeness, right, of all sales invoices. So we will test the internal control over completeness and do less work of a substantive nature as it relates to completeness. Now you see in PowerPoint 22, in the various boxes, there are X's that appear, right? So in any box where an X appears, that means the internal control system is giving assurance to the auditor where the X's appear. And obviously some of the boxes are blank, right? So the blank boxes are the boxes where there is no assurance given by the internal control system as it relates to the assertions. Now, these assertions that we see in this PowerPoint, existence, completeness, valuation, ownership, and presentation, we already noted these are typically the most important 5 assertions made by management in the financial statements. So these are typically the ones that the auditors are most interested in, right? So wherever we see an X in this PowerPoint, we can see the auditors can get quite a bit of audit evidence, right, from the internal control system if it's working properly. And we've already mentioned testing of internal control is a very important way to increase the efficiency of an audit. So from an audit perspective, auditors are very aware of, okay, this particular PowerPoint that we have. So auditors are going to test the internal control system to obtain audit evidence about existence of transactions, completeness of transactions, valuation of transactions, okay? And after we obtain evidence from the internal control system as it relates to these assertions, then the auditors will decide what additional substantive procedures do we need to do, okay? Now, obviously, where their boxes are empty, okay, in this PowerPoint, it means the auditors can take no internal control reliance where the boxes are empty. So it means the auditors would have to do substantive audit procedures to gain audit evidence in areas where the boxes are empty. And that's why we've talked before, audits consist of a mix of procedures, a certain amount of testing of internal control, right, to gather audit evidence where the X's exist in the boxes here, and then substantive procedures as well to gain evidence about where the X's are in the boxes, but also to gain evidence about where there are no X's, right? Because the auditors still have to fill in all the boxes, right, and get evidence in all these areas. So they do part of it through testing of internal control and part of it through substantive procedures. So PowerPoint 22, as I said, one of the most important PowerPoints in the entire course. You might even want to print a copy of this and sort of keep it in your accounting records, because it'll be helpful even as you go ahead and take other courses which involve internal control discussions. You can sort of refer back to this as a reminder. But certainly for this course, we're going to see this later after the midterm exam. We'll be talking more about internal controls in specific accounting systems. And of course, the reason for those controls are to give management, right, comfort that the assertions they're making are correct, right? And of course, it also gives the auditors evidence that the assertions are correct. So it's both purposes, management as well as the auditors. Okay. Now we saw something before called the audit risk model. Right, so we're going to come back to that. We see here in PowerPoint 23, is the auditor may determine that not all other control objectives are met for a particular account balance. Okay, so that's the idea. Let's go back. The auditor might test the internal control over validity and determine the control is not working, right? Or it's only working intermittently. It's not working all the time. So that's what they're talking about here. The auditor may determine that not all the control objectives are met for a particular account balance because the control either it's not working or maybe it doesn't even exist. So where controls are not working or they don't exist, we have to do substantive procedures, right? And so again, if we look at PowerPoint 22, right, if we want to gather, right, evidence in some of the boxes that are empty, right, that is telling us we can't get it from the internal control system. So we would have to do substantive procedures. But even where the X's do exist, if the internal control is not working properly, we'd still have to look at, can we do substantive procedures to meet the objective, okay? And then if we look at the audit risk model, we said AR, audit risk, is a function of IR, inherent risk, multiplied by control risk. Control risk is the risk that management's internal control system will fail to prevent, detect, and correct material errors in the financial statements. IR and CR together, we said, are called the risk of material misstatement. And then multiplied by DR, detection risk. Detection risk is the risk that the auditor's own procedures will fail to detect and correct material errors in the financial statements. So when we look at this, just from a broad, high level, we say audit risk is a function of the risk of material misstatement, IR and CR combined, multiplied by detection risk. So if the risk of material misstatement increases, right? If IR times CR increases, and you want to keep AR constant, for example, at 5%, we have to decrease detection risk. Right? So as the chance of material risk increases, we have to decrease detection risk as the auditor. How does the auditor decrease detection risk? They have to do more substantive procedures, right? Just keep in mind, we said audit risk, auditors want to keep no more than 5%. So if we said AR is 5%, as IR times CR increases, it means DR has to decrease, right, to compensate, to keep AR at 5%. DR, again, that's the auditor's own procedures. So to reduce detection risk, so to reduce the risk that the auditor would miss something, right? That their own audit procedures would fail to detect and correct material misstatement, the auditors have to do much more substantive procedures. On the other hand, if the risk of material misstatement was decreasing, right? The risk of material misstatement was low because the internal control system is strong. That means DR can increase, right? So the risk of material misstatement is decreasing, DR can increase, assuming you want to keep AR constant. How do auditors allow detection risk to increase? They do fewer substantive procedures. Keep in mind, right, substantive procedures are more costly than internal control procedures. So the idea from management's perspective would be we want risk of material misstatement to go down, right, be as small as possible, which means have a very strong internal control system. So auditors can allow detection risk to go up, which means our auditors won't have to do as much work. That will keep the cost of the audit down. Okay, everybody, my computer system had frozen there, so I'm just going to make a few more comments because I'm not sure exactly where the system cut off. So this is an important matter. So I just want to repeat it again. So if you've already heard it, I apologize, but just to ensure that we cover it off properly. With respect to auditors, audit risk, we mentioned before, auditors' risk is a maximum of 5% normally. So if we look at IR and CR together, we call that the risk of material misstatement. So we can see if we want to keep AR constant at 5%, if IR times CR increases, that means DR must decrease to keep AR at 5%. How do auditors reduce detection risk? They reduce detection risk, which is the risk that their own procedures will fail to detect and correct material errors. They overcome that risk by doing more work. On the other hand, if management's internal control system is poor, such that IR times CR, which we call the risk of material misstatement, if that increases, then to keep AR constant at 5%, detection risk, of course, has to decrease, which means auditors have to do more work to ensure that they discover material errors. On the other hand, if risk of material misstatement decreases, that can only occur because management system of internal control is strong. So if management system of internal control is strong and the risk of material misstatement is low, that means auditors can allow detection risk, the risk that their own procedures will fail to detect and correct financial statement errors, to increase. How do auditors allow detection risk to increase? They reduce the amount of substandard procedures they do. So basically, it's in the best interest of management to have a strong internal control system and to minimize the risk of material misstatement for their own purposes, right? Accurate financial reporting, efficiency, and effectiveness of business operations, ensure compliance with laws and regulations, and it also reduces the cost of the audit because the auditors will need to do fewer substantive procedures. So basically, a strong internal control system, right, is something that management should strive for. Now, when we talk about control evaluation, right, we've said that auditors have to identify the controls in the system, select the key controls, meaning the best controls that will prevent, detect, and correct material errors in the financial statements should they occur. And once we do that, of course, we have to evaluate the controls. So we have to identify the controls, meaning understanding what the control system is, assess control risk, right? The risk that the control will fail to prevent, detect, and correct a material error in the financial statements, and then test the controls that we want to rely on, okay? Major audit, of course, objective is to be efficient because then we can charge our client, right, lower fees. And so we want to, by being efficient, we want to take the least time possible, consistent with doing high quality work, of course, and meeting all the professional standards that we've talked about earlier on. So as we're commenting today, the more that auditors can rely on a good internal control, the less substantive work they need to do, right? So the auditor, in terms of their audit strategy, they can opt to rely on the internal controls, right? Not to rely on internal controls and do extensive substantive procedures. Normally, that's not done. It might be done in a very small organization, right, where one person controls the accounting records and does all the management functions. In that case, where one person's doing everything, there will be no controls on which you can rely. So in a small, perhaps non-for-profit organization, you might only do substantive procedures. So it's possible, but very rarely done in the business world today. Secondly, it says the auditors can perform a complete evaluation of internal control, assess control risk. Remember, control risk is IR times CR. Assess that risk to be low, and then reduce our substantive procedures. Because if the internal control system is strong, IR times CR is low, so detection risk can go up, which means we can minimize or reduce our substantive procedures. And so the auditor needs to, of course, determine what's the mix. What's the mix of the internal control procedures that they're going to do, and what's the proper mix of the substantive procedures. Remember, substantive procedures, we mean analytical procedures, so doing ratio analysis, comparison, basically type work, or are we doing tests of detail where we actually go back and look at basic accounting records? Okay, so we want to continue on. Part of what we said today when we talk about management's internal control system, we said, well, there are general controls and there are application controls, right? As I mentioned earlier, I usually refer to these as high-level controls. Those are the general controls, and detailed level controls or low-level controls, and those are the application controls. In this PowerPoint, it says general controls are those activities that have an overall impact on accounting processes. So what are the high-level controls in an organization that will impact the accounting process? And then the application controls, as it mentions here, addresses the control objectives. What are the control objectives? Validity, authorization, completeness, right? Those control objectives relating to the input of data, the processing of data, and the output of data. And so we think about an IT system today. When we talk about auditing an IT system, we often talk about what are the input controls into the system, what are the processing controls while the IT system is actually processing the data, and then what controls do we have in place over the output, right? Once the IT system spits out the data, how do we control the data at that point? So we can have application detail level controls. One thing to recognize, though, in order to have effective application controls at a detailed level, you must have effective general controls. Okay. Normally, if your general controls, again, keep in mind these are the high-level controls, if those are not effective, you're not going to have effective application controls. But if you do have effective general controls, you have the possibility, at least, of having effective application controls. Why is that? Because the general controls at the high level, those are where the people are involved deciding, right, what the application controls are going to be. So if you don't have good people in your organization, they will not implement good application controls. If you have good, knowledgeable people in your organization, then you have a chance, right, of putting in effective application controls. So to have effective application controls, you do need to have first effective general controls. So for the next few minutes, we're going to talk about what are the general controls in an accounting system. Okay, so keep in mind again, these are the high-level controls. Just go back to the previous PowerPoint. The general controls are the activities that have an overall impact, okay, in terms of the accounting system and the recording of data, ensuring it's accurate, right, ensuring it's valid, ensuring that the transactions are properly authorized, ensuring the transactions are recorded in the proper period, right? What are the general controls that ensure those objectives are met? So the first one, capable people, right? Capable personnel. The most important feature of an organization is who makes the system work. It's actually the people, right? And so you will often hear, if you want to have a good business, you need to have good people. Very, very true, because business people make businesses work, right? So if we have high turnover in a business, that may mean we'll have inexperienced people, right, dealing with the internal control functions. So when you have new people come into an organization, you have a learning curve, right? It takes them a while to get familiar with the business and the controls that exist. So the more turnover a business has, the weaker its general controls will be, right? Because you're changing people constantly. And of course, when you change people constantly, mistakes could be made, right? It would be like, I'm teaching this course now, right? But if we brought in another instructor, right, for the next four chapters, and then brought in another instructor for the next four chapters, you would have a disconnect, wouldn't you? Potential, right? Because you're changing instructors. The approach might be different. How they teach might be different, right? And even if they were trying to do what I'm doing, it would take them time, right, to figure that out. So higher turnover generally means weaker general controls. The next bullet point says new accounting officers and managers may not have sufficient experience, right, to make technical and judgment decisions. So high turnover is a problem, but then when we bring in new people, do they have the experience, right? What's their technical knowledge versus the person that was there before? What's their judgment capabilities versus the people that were there before, right? So normally in a business, right, retention is very important. Retention of people to have good overall control in your business. The second general control is performance reviews. Management's reviews of reported performance compared to expectations is an effective control. So how do we do performance reviews? Well, comparison to budget, right? So by having a system where we check, right, by comparison of actual results to budget, that's a way we can control what's going on in the business. Because if we have variances that develop, right, if sales are not meeting budget, we have to get into that. Why are we not meeting their budget, right? If expenses are running more than budget, why are we spending more than our budget, right? It allows for. And so it just raises questions which have to be followed up, which can detect problems, right? And the problems might be inaccurate reporting in the financial statements. So at least the budget comparison process is a way to raise questions and then follow up. And as part of that follow-up, ensure that the underlying data is correct. Right? So performance reviews for the business. A third very important general control is segregation of duties. You see the PowerPoint calls it segregation of responsibilities. Sometimes it's referred to as separation as opposed to segregation, a separation of responsibilities. And so what we're referring to here is proper segregation of responsibilities is a necessary condition for making detailed controls effective. Proper segregation of responsibilities provides two main benefits. Innocent errors are more likely to be found as more people are looking at the transaction. Right? So by proper segregation of responsibilities, for example, we should not have the same person, right, writing checks in our business. That person should not also record the checks in the accounting records. Okay, that would be a poor segregation of duties, because someone who's actually writing the checks, right, has that authority, could write a check to someone, right, who a check should not go to, and then if they're recording that in the system, right, they could hide who they wrote the check to, because they're involved in writing the check and in recording the check in the accounting system. So you would want to separate, right, the recording of checks from the preparation of checks, okay? And so it's important when you analyze responsibilities in the accounting process that you do not have inconsistent duties done by the same person, okay? And so you want to ensure that there is not the possibility that collusion would occur, right, in a system between two or more people, okay? So normally you want controls in place, right, where there's a number of sets of eyes looking at the data, right? And the more segregation we have, the better, okay? Now, of course, there's a cost, right, to having good segregation of duties. If you have several people involved in looking at a transaction, that increases the cost, doesn't it? So quite often in small business organizations, okay, small businesses, private companies, the segregation of duties is often poor. It's poor because private business owners don't want to invest in more people. They try and keep their overhead low. On the other hand, for large public companies, capital, right, is more readily available. So they tend to have better systems of internal control, more people involved, and they can have a better segregation of duties. So in large public companies, normally auditors are able to rely on proper segregation of duties as a key control. Okay? But in a private company, normally auditors could not do that. Okay, so segregation of duties, we'll be talking more about that after the midterm exam when we start looking at the detailed accounting cycles. So this next PowerPoint gives us more examples about some of the duties that should be segregated or separated from each other. So the things that should be separated, the authorization to conduct a transaction should be separated from the actual recording of the transaction, right? So for example, my person who is preparing the checks, right? So executing the transaction should not be the person who's recording the checks, right? I mentioned that a minute ago. Okay, so authorization should be separated from recording, which should be separated from the custody or physical control over the assets, right? That person writing the check should not have the ability to have access to cash, right, in the company. But if that person can write the check and no one else, there's not a second signer and no one else looks at the check, then they do have effective custody over the cash in the bank, right? So they're doing all these duties. Those are inconsistent duties, right? You have to separate these. So authorization should be separated from recording, which should be separated from custody. And then in addition, there should be a reconciliation of amounts recorded in the general ledger to amounts that exist. So for example, the bank reconciliation, right? We're reconciling what's recorded in the general ledger for our bank balance to the actual bank statement and what it says, right? And accounting for any differences. And of course, that reconciliation should not be performed by someone involved in the authorization, recording, and custody of assets. Right? So all of these different functions need to be separated in order to have an excellent segregation of duties in a business organization. Very important. Okay, so it's probably, when you look at it, it's certainly one of the top internal controls that businesses need to have, proper segregation of duties. There's unfortunately a number of frauds that have occurred even in a recent area here in various businesses because of poor segregation of duties, normally in private companies, but we've had some hospitals, for example, locally where they've had some major frauds because of these types of problems, poor segregation of duties. The next general control is supervision, right? Someone monitoring, right? So if someone's overlooking your shoulder, right, what's the chance that you're going to do a better job? It's probably higher probability, right? So supervision is important as a way for management to monitor and maintain the system of internal control. So by supervising, they're supervising people, right? And ensuring that people are carrying out the duties that they should be carrying out. So when you know that someone's watching, you're going to do a better job, right? When someone's not watching, you might not do the same job or as proper of a job. The quality might be less, right? And so supervision is very important, right? It's someone checking, right? Checking in that everything's functioning properly. We can look at that negatively and say, well, you know, they're just following up to make sure I'm doing my job. Well, they are following up to make sure you're doing your job, but that's part of the control system, right? Is to make sure everybody's doing their job, because your supervisor is actually being supervised as well, right? By their supervisor. So everybody's watching, right? And to have a good internal control system, okay? Okay, another general control that exists, which is generally important, but more important in certain types of businesses than others, controlled access. Right? And so by controlled access, generally we're talking about physical access to assets and to accounting records, okay? So if you want to have good internal control in your business, you have to restrict physical access. Now, when we talk about physical access, the second bullet point here says assets such as cash, inventory, or securities, bonds, stocks, should not be available to persons who don't have a need to handle them, right? So, for example, in a bank, right? If you walk into a branch at the bank, who should be going into the vault, right, at the bank? Typically, it would only be one of the tellers, and normally not by themselves. Usually, two persons have to go into the vault to have access to the cash. And normally, of course, there's a lock on the door to the vault so that one person can't get in there by themselves, and certainly anyone walking in from the outside can't get in. Right? So there's going to be a type of security code or a key to control access. Same thing about inventory. If we think about a jewelry store, right? Jewelry stores have to have controls over their inventory. So at nighttime, right, in a store, they don't leave all the jewelry out in the jewelry cases, do they? They take all the jewelry out and put it back in a vault for physical control over the assets. So if someone breaks into the store at night, they can't get the jewelry, right, because it's all put away. Okay, so if we more tightly control, right, our assets, it means there be less risk of loss, which of course supports the existence, right, of assets as recorded in the financial statements. But also, it's beyond talking about things like cash and inventory. It's also to have important to have proper control over our accounting forms, right? So things like blank checks, right? You don't want to leave blank checks available where anyone can just go pick up a check and start writing checks and put, the CEO's or the CFO's name on the checks and cash them, right? So we have to have proper control over our blank forms, whether they're blank checks, that's very important, obviously, but even other things like sales invoices, right, or purchase orders. All these documents, right, can be used to either manipulate financial statements, or a purchase order could be used to create a liability, right? You send a purchase order from your business to another business to buy goods, right? Or if you did that, you could put a shipping address on the goods, to your own house and have the bill sent to the company, right? So the more that blank forms are left around, it just opens up the door to manipulation by staff. So you want to ensure there's controlled access, right? So basically things are kept in a locked storage room or otherwise somehow tightly controlled. The next general control, which really ties into a bit what we talked about before, periodically doing comparisons and reconciliations, right? So we mentioned bank reconciliations, of course, helps to ensure the accuracy, right, of financial statements, but more general comparisons do as well. So looking at the PowerPoint, it says periodic comparison of recorded amounts in our general ledger to independent evidence, meaning things outside of the accounting records, needs to take place on a regular basis. So for example, a periodic comparison would be at the end of the year, let's count our inventory to see how our inventory count, our physical count, compares to the inventory that we have recorded in the general ledger. Right? Or on a smaller scale, let's take our petty cash, right? The petty cash fund that companies have. Let's actually count the amount of cash and see how that compares, right, to what we have recorded as petty cash. Let's do our proper reconciliations each month. If we reconcile our accounts receivable control account in the general ledger to the account receivable subledger, which contains all the detailed invoices to our customers and all the payments from our customers, we have to reconcile those monthly normally. That helps to ensure the accuracy of the accounting records, because the comparison and reconciliation might point up problems, right? But of course, these reconciliations, as we talked about with the bank reconciliation, they have to be done by independent people, right? They shouldn't be done by people who have control over authorization of transactions, custody, or record keeping, right, for the assets. So again, the person who's doing the bank reconciliation should not have authority to record checks or deposits, should not have physical control over cash, so they should not be making deposits at the bank. They should not be involved in the check writing process. Right? All these things have to be properly separated from each other. And then on top of that, having comparison and reconciliation helps to ensure the accuracy of the accounting records. We need to have the next area, general controls, in the area of IT controls. right? So when we talk about IT, of course, in today's world, virtually every business has an information system. So by general IT controls, we're referring to what are the policies and procedures that a business has in place in order to ensure, right, the accuracy of its internal financial statements. And when we talk about in IT controls, we can talk within that subset about general IT controls and detailed IT application controls. Okay, so by detailed application controls, we mean what are the IT controls over the sales system, right? The application system is the sales system. What are the IT controls over the purchases system? What are the IT controls over the payroll system? So sales, purchases, payroll, those are all application systems. We need application controls over each of those systems. But just like we have general controls over the general accounting system, we need general controls over the IT system. And those general controls, of course, relate to the entire IT environment in total. So when we talk about general controls in the context of an IT system, this PowerPoint number 35 talked about the types of controls that you need to have at a general level over all application systems. So these controls exist whether it's a sales system, a purchase system, or a payroll system that we're talking about. So let's look at this laundry list. It says the operating system and application of software, the acquisition of it, the development and maintenance of it should be controlled. And so we have what we call a life cycle with respect to software. So how do we control the internal development of software, the acquisition of software from the outside, and how do we ensure that software is properly maintained on an ongoing basis? So we need to have acquisition, development, and maintenance controls regardless of whether we're talking about sales, purchase, or payroll, right? The general IT controls are pervasive, right? They affect all the detailed application systems. We need to control access security, right? How do you gain access to a system? Well, normally through passwords, but we know we have other systems, right? Thumbprint, voice recognition. There's different ways that you can gain access to IT systems. So which controls are we going to use, right, in our business? For large companies that have data centers, right, data centers, you think about, a big room with huge computers in it, right? How do they control access to that room, for example, right? You may have a log, right, where people have to log in when they walk into the room, okay? Network operations, how do they control the operating of the network? Who has access to the network? How is it physically controlled? When do they generate reports, right? At what time in the day? So these are all broad, high-level issues, right, that have to be addressed as part of your IT system. How do you do backups, right? Whether it's a sales, payroll, purchase system, you need a backup procedure in place that's common, right, throughout the company. How about if the systems go down, right? Do you have a disaster recovery plan in place, right? How do we operate without our computer system? Right? So if we think about the whole idea of, COVID, for example, before COVID came in, we went to the university campus, right, and carried on our classes there. What was the backup plan if we couldn't do that? Really, there wasn't one, right, because that had never happened before, at least in our lifetime. And when COVID hit, all of a sudden, okay, we had to develop the backup plan very quickly. Well, thank goodness, right, in the world today, our computer technology is such, right, that we can carry on classes online. Most of us would probably say, it's not as good as being together, because when we're together, right, there's a different relationship between us as individuals, right? We can see each other face to face. And because of that physical closeness, there may be more interaction, of course, between instructor and student. But over a longer period of time, you develop a relationship, right? Hard to develop, right, a professional relationship between instructor and students, right, when, we can't see each other on a regular basis. Unfortunately, right now, we have to deal with the way it is, right? So it's not a perfect system, but it is a system. And this backup system was developed very quickly, right? In order to, of course, allow the university to carry on its business, but also allow all the students, of course, to come and get their education so they can carry on with their lives. Then with respect to our IT assets, hardware, software, how do we physically control, right? Ensuring that our equipment doesn't disappear. How do we control software to make sure that it's not damaged, but that it's properly maintained? So all these controls that affect our IT systems, right, are the general controls. There are specific controls in each system. Again, we'll talk about that after the midterm, but the general IT controls affect all systems, okay, is the point. The application control procedures, again, as I said, those are the detailed level controls. They give an example here. So specific procedures are used in each accounting process to meet the control objectives of that accounting process. So for example, if you need a control to ensure sales invoices recorded are complete, that's different than ensuring all payroll checks are complete, right? The nature of the system is going to make the control different. That's what they're referring to here, okay? They do give us an example, though. It says the sales data input clerk verifies that each sale on account is to a valid customer on the approved credit list. So before a sales invoice will be recorded, the system checks to ensure that there's a customer number, right, assigned to each sales invoice. If the invoice does not have a customer number, it can't be processed, right? So that will be one type of check, right, to ensure that when sales invoices are processed, that they're actually customers that exist. Why? Because they've been assigned a customer number. Okay, so these types of controls, again, we'll look at more after the midterm break. Okay, so I'm looking at my time, and very often this is sort of where I end up before the midterm. I don't quite get through all of chapter 9. So we're on PowerPoint 37 right now. There's a total of 59, so there's still 22 more to go. But we're talking about phase 1, 2, and 3. We've just completed phase 1. So what I'm going to do, I'm going to stop here at this point. Obviously, phases 2 and 3 we will not talk about until we come back from the midterm break. Okay. So when we come back, I'll do a little bit of a refresher just on what we talked about in chapter 9 so far, and then move on to finish off chapter 9. And then obviously we'll be moving on into chapter 11 next. Okay. So with respect to the midterm exam in chapter 9, only what I've talked about today could be on the midterm exam. Okay, so up to PowerPoint 36, that could be on the exam. Nothing from 37 to the end, of course, because we haven't covered the material. Okay, so again, everybody, good luck in your preparation for the midterm exam. If you do have questions, just shoot me an email. I'll get back to you on that. Otherwise, I will be sending out an email next week to you just to document in writing what the procedure would be around the midterm exam. And again, I've already talked about the format of it, what you can expect. But if you do have any questions about that, feel free to send me an email. Okay. Thanks, everybody. Have a good day and continue to be safe. And we'll see you probably, I guess, the next day will be midterm exam day. Okay. But we'll be back and forth on email, I'm sure, over the next couple of weeks. I will be available next week if you do have questions, even though it's reading week. I'll be checking email. Okay, so feel free to contact me if you would like. Okay, take care, everybody. Have a good day, and look forward to seeing you virtually on exam day. Take care.